Seller financing is the best way to buy a business, and most people have no idea how it works. So in this video, I'm going to break it all down and give you tactical advice that you can use to do your very first seller finance deal. My name is Brian Beers. I've done over $6 million of seller finance transactions. We've done deals as small as $100,000 and deals as big as $2 million. My company starts, operates, scales, and invests into franchises. So comment below if you have any questions about seller financing or franchising, and subscribe to this channel if you get value from this video. This is a map of all of our franchise locations. In this business, we operate automotive repair shops. All the gold stars that you see are shops that we've acquired using seller financing, and the blue pins are ones that we paid cash, got a bank loan, or started from scratch. As you can see, more than 2/3 of our company, we've used seller financing to acquire. And so to give you an idea of how powerful it is, here is the P&L of an existing franchise that we bought for just $52,000 down. It was a down payment that generated us $370,000 of profit in the first 12 months. And here is a P&L of another one where we acquired it for $50,000 down that generated $173,000 of profit in the first 12 months. How does this work? Let's get into the basics. Let's pretend we have a transaction for $100,000, and then we have three parties involved. We've got the buyer, the seller, and the bank. So you're buying this business for $100,000, right? So you go to the bank and you say, hey, I got this business I'm buying. It's $100,000, and they're going to loan you up to $80,000, 80%. So you come up with this deal. The bank will send the $80,000 to the seller, and you then have a note with the bank, which is just a promise to repay them. And then you send as a down payment $20,000 to the seller. So the seller walks away. They've got, $100,000 in cash. You take over the business, and then every month you are making payments back to the bank that include, a small portion of that $80,000 plus interest, right? Every single month. And so the easiest way to think about seller financing is that the bank, right, cross out the word bank and write the word seller. So the seller becomes the bank in that, they are like loaning you the money to buy their own business, right? And then every month you are going to make payments to the seller that include principal and include interest. Plus you're going to have that down payment that you're going to pay. And that's the simplest way to think about it, right? A lot of people think seller finance is like really complicated and there's all these things, but at the end of the day, the seller steps in. You write a bunch of documents, right, that spell out the terms of all the rules. The seller becomes the bank. And then you're saying, well, what happens if what happens as a buyer if the buyer runs low on cash? What happens? What kind of leverage does the seller have as the bank to make sure they get paid? Well, a good lawyer with good documents will make sure that the seller has all the same protections a bank would. If you're late on your payments to the bank, you have late fees, right? Your interest rate goes up. The seller will have all that. They will have security. So as the buyer, you will be putting up collateral, which could be, assets of the business. It could be a personal guarantee. So like your personal, bank accounts and brokerage accounts and, potentially even equity that you have in real estate, depending on the documents, could all be used as collateral, which basically means like, these are what you're putting up to say, hey, if I don't pay, you have access to these things, right? This is how banks work, and this is what gives sellers confidence that they're going to get repaid. Because if they don't trust that they're going to get repaid, like why would they lend you the money, right? They'd just be like, give me my money and get out of here if they don't trust you. That's the easiest way to think about it from a transaction standpoint. And now you're probably thinking, well, why would a seller go ahead and want to deal with the headaches of getting payments every month, right? Why wouldn't they just take their money and go off into the sunset? And there's really 5 main reasons that a seller is going to do this. And here they are. And I want to note first, to get to these pain points, you need to talk to the seller and ask very specific questions and then dig in for specific answers. If you stay surface level, you're not going to get to the truth, and you may not be able to convince them to see seller financing as a good solution. So the pain point number 1 is speed. They want to close the deal quickly. We had this one where a seller's wife got this dream job down in North Carolina, and it required them to move from Pennsylvania. And so they had a very specific deadline. They had to move. And just the idea of, having this business to find a buyer who would have to get an SBA loan, who the franchisor would have to vet, and all this stuff. Like, it could take way too long. And then they were worried that, hey, this deal could fall apart at the finish line. Like on moving day, it falls apart, or just as they get down there. And now they still have the business, right? They have the lease, they have the employees, they've got all these issues. And it would be a huge distraction for them and pretty big problem as they were trying to start the next chapter of their life. And so speed for them was an extremely important part. And so for me to come in, like, I can get a seller finance deal structured, closed in like 45 days, right? A lot of it depends on the lawyers and the franchisor in my case, but you can move very quickly when you're not involving the bank, especially when it's two parties that trust each other. Like, I had a relationship with this guy, and so speed is very, very important and a really big one for people. Pain point number 2 is un-bankable. Some deals are too small, the profits are too thin, or the business is simply losing money. And it's almost impossible to get a loan if you have a business that doesn't generate enough cash flow to meet whatever the bank's requirements are. Stay away from these deals though, unless you know the business well. In my franchise business, we've run this turnaround playbook enough times that for me, it's rinse and repeat. For example, we bought this shop in January of 2022. It had done $500,000 in sales the previous year. In my world, that business is losing over $100,000, like burn, $100,000 out the window, doing 500 grand. And we, in the very first year, got it to 750,000, which is, very close to our break-even point. And then we did 1.3 million in the second year that we owned it, which is profitable. You run this big risk of buying an unbankable business that's not profitable if it's your very first deal. Now, if you're in the franchise world like me, like you buy these things, you have this playbook, you do it over and over again. And so I'm able to take on more risk and more potential losses because I have a larger company. We can sustain those losses, which, make it possible. And so you want to be very careful. If it's your very first deal, I don't know if I would get into one that was losing money like this unless you are very confident in your ability to turn it around quickly. That brings me to pain point number 3, which is to defer taxes. Sellers get hit with a massive capital gains tax bill after they sell the business. And if they do seller financing, the IRS allows them to spread out that tax payment over the life of the loan. For example, if someone has a $50,000 tax bill and they seller finance over 5 years, they will pay roughly $10,000 a year in taxes, right? So every year they're going to chunk off and pay a portion of that tax bill in proration to the amount of principal that they receive on the loan. Now, obviously, I'm not a CPA. The seller needs to consult with their accountant for what their personal tax situation is. But most sellers see this as a huge benefit. It is one of the many reasons that they're willing to do this. In fact, I will plant the seed here to say, hey, you get to spread out your taxes. There's this big advantage. You can defer it, talk to your accountant. They go to their accountant. The accountant says, yep, totally right. That is 100% accurate. Well, this will help spread out that tax bill. And so most of the time, the accountants are coming back in my deals supportive of this, and it becomes a very positive thing for them. Pain point number 4 is passive monthly income. Business owners are used to getting monthly cash, and after they sell the business, that cash flow goes to zero. And sellers like the idea of an automated ACH hitting their bank account every single month for the next 4, 8, 10 years. It's very reliable, it's steady. In my cases, I am the retirement plan of 7 families that we've acquired, businesses from. And so I'm supporting their retirement. I am generating passive income for them. And so that is a very appealing part. And so finally, pain point number 5 is they want more money. The sellers are earning additional interest payments instead of the bank. So every month you're making principal and interest payments. Well, now instead of the bank getting that money, they are getting it, right? And it's also possible, depending on how you structure the deal, that the interest that they're earning on that capital is more than offsetting those taxes. So remember, we talked about he has a $10,000 a year additional tax obligation. So it's possible that we can be cash flowing over $10,000 a year of interest, which is offsetting those payments. That's part of it. The other part of the money equation is that the seller may want, and you may agree, to a higher valuation than what the bank thinks the business is worth. And if this happens, the bank may only offer to lend 50% of the money, leaving the buyer with this huge down payment that could kill the deal. For example, what if this guy wanted $200,000 and the bank says, well, it's only worth $80,000 to us, like it's only worth 100, so we're only going to loan 80. And then now you as the buyer not only have to come up with 100,000, you're going to come up with 120,000, which may just not happen at all. And so sometimes the seller can actually get a higher price if it makes sense and you both agree to it. For example, this happened to me, last year. And normally we're buying, these small cash flowing franchises for about 2.5 times cash flow. There's this location that we were going to buy that was doing $100,000 of profit. And so normally we would pay 2.5 to 3 times earnings. So for us to buy this business, cash flowing $100,000, we would pay $250,000 to $300,000 is like normally like a fair price for us. But the seller was stuck on wanting $500,000, right? A 5x on the business. So more than double what we thought the business was worth based on the low cash flow. But, we felt great about the locations. We felt great about our ability to improve the operations, to drive the sales, to fix the margins, to reduce the costs, like all the things that we do really well as operators. We were confident in this. So we buy this deal. And in the first year, very first year, we did $400,000 of profit on the same exact business with many of the same employers. And to make it even sweeter, this was a seller finance deal that we put $50,000 down, and it generated $400,000 of cash flow, meaning we got an 800% return. An 800% return on that money. That's not too bad. And then, that's like the best part about buying a franchise and being an entrepreneur and having your own business is investing cash flow back in your own business. You can get the craziest return versus if I took that $50,000 and I invested it into the stock market, and maybe I made 20%. It was a great year. I made 800% buying my own business for myself. And that is how you can exponentially grow your wealth as a franchisee, as a small business owner, is you invest back into your own business and you scale it. And seller financing makes it all possible since you can get these really good deals that otherwise, you wouldn't be able to get. Like I would have not been able to go to a bank and get this deal. Anyway, I hope you got value from this video. As a franchisee, you don't have to reinvent the wheel. You don't have to reinvent the wheel on how to buy these things either. Follow this playbook, use seller financing, and then just you repeat the process over and over again. And so if you have any questions on seller financing, how to structure these deals, how to find these deals, subscribe to my channel, and I look forward to seeing you in the comments. Cheers.